Hello, happy Friday, August the 14th, 20 minutes after 1. Try to make a real quick video here for you just on some of the things that we've seen this week. It's been a very interesting week for two main reasons: the movement in interest rates and the movement in gold. And both of those are interlinked. Of course, when interest rates start to spike, that of course changes the real rate perspective, which changes the interest in gold. So in most cases, when you see real rates decelerate and go down, price of gold will continue to go up, and vice versa. The conversation, I think, for most on Wall Street this week was that, see, look, interest rates are going up, and because of that, cyclicals are going to come back, and we've got a whole huge rotation happening within the marketplace. I don't believe that that's the case. I don't believe that that's true. The all indications continue to point towards the movement to and through a stagflationary environment, meaning low to no growth and higher inflation. When you get higher inflation, it's represented in the movement of a lot of different things: metals, food complex, commodities in general. It doesn't take much to figure out that that is in fact happening. Just go to the grocery store and buy something. In most cases, whatever that thing is, it's going to be quite a bit more expensive than what it was even just 6 months ago. Lumber, just as an example, is up about 100% in 4 months, which is just nothing short of amazing. So at any rate, we had this move in interest rates that was interesting. Let me share my screen with you real quick, and you can see the movement in the interest rate complex as referred by the 10-year Treasury. Here we were last week with a low on interest rates of 0.50%. And we went from this low to yesterday's high, which was about a 42% increase in the movement or the rate of change of interest as represented on the 10-year Treasury inside 6 or so trading days. This white line that you see here is what we call immediate term trade resistance, and that number is 0.71%. Yesterday, it hit a high of 0.727. So still within range, and interestingly enough, this same thing happened back here on June the 5th. So on June the 5th, interest rates went through about a 5-day spike to a high at that time on June the 5th. And then on June the 8th, which was a Monday, interest rates backed off a little bit. All right. Well, the same thing is happening today. Interest rates are backing off a little bit. It wouldn't surprise me to see them, peak this line again, or even breach it a little bit. But we think we're in this range where interest rates are going to turn around. And the reason I say that is that, as you know, every single day I get up and the process and analytics team that we work with does an analytical approach to the market based on fractal geometry, differential calculus, and the things that make markets move, math, right? I know lots of people would like to argue with that, but the reality is that the market's built on math. And so therefore, we have a probable range of movement of every asset class on a day-by-day basis. And what we just experienced in interest rates was a widening of the interest rate range from a new all-time low of 0.48% to a high of 0.72%. And so what's that mean? It means when interest rates are going up like this within the lens of a specific economic quadrant, such as stagflation, and below a certain trade resistance level, like I just showed you, you buy those bonds when interest rates are high, you sell those bonds when interest rates are low. And what we find over a long period of analytics is that when an asset class starts to tap or breach the upper or lower bound of that mathematical range, the other side becomes in play. In other words, if it's tapping 0.72% on the 10-year Treasury, the probability of it moving down to 0.48% is much, much higher than it continuing to go higher, until that trade resistance is solidly broken and the trend changes. And so we'd have to see a dramatic shift in a number of different things for that to occur, not the least of which would be a dramatic shift in the probabilities of stagflation being the outcome. But again, if you look at the commodity complex, it's pretty easy to see that we do in fact have a substantial amount of inflation happening. Reported this week was the CPI, and it was a very big jump. it's likely to continue to jump from there based on just the simplicity of what's happening within that complex. So again, let me share my screens with you so you can continue to follow with me. So what that means is that we started to build a bigger position in our longer term treasury position here. We had about a 5, 6, or 7% position in this range, and then we continued to buy on the way down at about 0.25% to 0.5% of capital per instance. And again, the objective is for us to buy when the price is down, interest rates are up, and to sell when the price is up or interest rates are down. And so therefore, if interest rates move back to an environment where we are experiencing a very low rate of interest, the likelihood that this thing moves up into this mid 170 range is pretty good. And again, we have to look at that through the lens of volatility. Bond volatility as measured by something called the MOVE index is still very muted. There were a lot of people who, if they pay attention to the MOVE index, got excited when they saw it go from 41 to 42 to 45. I can tell you that anything in that 40 to 45 range is just nothingness. There's no excitement there. There's basically, that index is essentially pricing in low to very no risk of an environment within the economic structure that would be problematic for longer term bonds. And that's the case that we have to continue to formulate and work with right now. So therefore, we're continuing to build our bond position, which helps to secure and minimize, we believe, a great degree of risk in the portfolio. The second largest position that we own is gold. And gold as represented, paper gold that is, represented by GLD, this is the range we want to be buying in. And so therefore, if we can get sub 180 on this, we'll be buying more and grossing up our positions even further. And we would do that because of through the lens of volatility, volatility continues to compress. So as volatility comes down, what that does is it makes it much more efficient and a much better place to be in terms of an asset class. And so therefore, we're continuing to increase exposure to the commodity complex in metals. As I said, gold, we view that as a currency, not a commodity. So we would gross that position up as it continues to either move sideways or come down within the lens of volatility getting softer to a maximum 12% position in the portfolio. From there, the commodity segmentation of metals would be things like copper, palladium, silver. Silver's a little bit more aggressive of a position, so it certainly wouldn't be in all of our portfolios. The food complex continues to inflate, so things like corn, wheat, soybeans, coffee, cocoa, the protein complex such as hogs and cattle. We have exposure to all those things. But what I will do is I will risk manage those positions by selling some when they get to the top end of their mathematical range, and then buy them back when they come down to the low end of the probable mathematical range. And in doing so, it just books some gains when they are essentially higher in price, and we buy them back when they're lower in price. And I know it sounds simple, right? Buy low, sell high. But that buy low, sell high has to happen within the context and through the confines of a very disciplined mathematical process. And so that's what we do every single day, is just put together the math of the market, track it moment by moment, and then work into or out of positions based on where they lie within their mathematical range. So core positions for stagflation continue to be technology, real estate. The real estate that we like are things that have focus on storage, towers, things of that nature. And so one of the symbols, XLRE, you'll notice in the portfolios is continuing to build, and we just work towards buying those on the low end of the range. Utilities and emerging markets, specifically within the lens of emerging markets, you'd see China, Indonesia, and Russia. Russia being a very strong play on the reflation of the oil market. And that'd be the last thing, is that we continue to expand our oil exposure dependent upon what's happening in the complex confines of the dollar itself. So when you look at the volatility measurements for oil, they continue to come in and minimize the risk to that marketplace. And I'll show you that real quickly. Symbol OVX representation for the oil complex. Anything in a 3 handle is really, really good for that environment. And as you can see, it's just continuing to be muted. So we'll buy some oil exposure on red. We'll sell some oil exposure on green. Wash, rinse, repeat, right? Plant, prune, repeat. That's the objective. So, of course, things continue to move along. I'm sure notice many more transactions within portfolios right now. That is a function simply of risk managing each of the positions as best as possible, capturing gains when that moves up through the mathematical probability of range of movement, and buying some back when it comes down and hits that lower end of the probable mathematical range. That being the case, transactions are free. E-Trade doesn't charge anything for that. So if I trade 1 or 1,000 times within a day or a week, it's not relevant in terms of any cost to the portfolio. But what it does do provides me the opportunity to ease into a position at 25 to 50 basis points of capital per transaction, so that we can just feel confident that that mathematical range that has been tapped is the correct area, that it's starting to capture the demand at that point, so on and so forth. So as you know, we have a very disciplined process that is founded on math, looks at it through the lens of price, volume, volatility, and I'll continue to work that modeling system on an ongoing basis, day by day, doing everything we can to minimize risk in this market. There certainly is risk out there, but the risk is not the same as what it was, prior to, say, May and in the June time frame. The one thing I did want to share with you real quick, though, is the following. I commented on how on June 5th, interest rates spiked back up into this range again and then fell back down. And so this movement looks very much like the movement that we saw going into that time frame of June the 5th. And I'm not suggesting this is going to happen again, but nevertheless, we have to recognize that this is what the equity market looked like at that time. This is Monday, June the 8th for the S&P 500. And then you can see how over the next few days we had some problems. Short-lived, nevertheless, but when you get a movement of 6% on the downside in a market of stocks, that potentially creates some problem and consternation. This market, as you can see, is coming up towards and bumping up against the February 19th all-time highs of 33.93 on the S&P 500. It's hard to know exactly how it's going to respond around that area. It could very well break up above it and just keep moving within a bullish trend, and that would happen within the lens of volatility if VIX can stay below 27. And so far it appears to. If VIXN, which is the NASDAQ volatility measurement, can stay below 33, again, the probability of price moving upward through that continues to be good. So again, we do have equity exposure. We just have very, very careful, disciplined equity exposure. Again, technology, real estate, utilities being the primary core equity holdings that work well within a stagflationary environment. And then on the emerging market front, China, Indonesia, and Russia being the exposure that we would like to have and continue to build around as we are. And then from there, inflation protection with treasuries, treasury inflation protected securities, and all sorts of commodities. And then, of course, investment grade bonds and treasuries to help round out the portfolio. So that's that. If you have any questions at all, by all means, please reach out to me and let me know. My direct line, 608-354-1977. My email, chris@careformywealth.com. As always, I'm so thankful to work for you. I appreciate every day being able to sit down and come to my office and just find ways to help risk manage and protect your portfolios and build them over time. It's been a very weird and to some extent strange and difficult 6 months, and I don't think the next 6 months is going to get any easier, so to speak. But we'll keep focused on the disciplined process of maintaining the math of the market, and as we do that, I'm confident that we're going to continue to work in an upward fashion with minimal amounts of downside risk, and that is my objective and my goal on a day-by-day ongoing basis. So Any questions at all, let me know. Thanks so much again for letting me work for you. And I hope to have an opportunity to chat with you soon. And have a beautiful weekend. See ya.